sometimes the errors themselves counterbalance each other. For example, overstatement of purchases and ending inventory. The entity placed an order of inventories amounting to 100,000 FOB destination. The same inventory is still on high seas as of the end of the year. Now, if the inventory is still in transit, that means your shipping terms would actually matter in order to determine whether or not the same inventory should be included in your financial statements. Now, in this case, it's FOB destination, so title remains at the seller until it reaches the destination. Since it is still on high seas, the ownership remains at the seller. So in this case, this order of 100,000 should not be included in the purchases as well as in the physical count. However, our entity, the entity erroneously included it in its credit purchases and at the same time it is recorded in the inventory end. So the purchases for that period is now overstated by 100,000. The same thing with ending inventory. Now the income statement is actually correct, or rather the net income is correct. So despite the error, the income statement is correct, or the net income is correct. How so? So first we determine the relationship between purchases and net income. Purchases and net income has an inverse relationship. That means if this is overstated by 100,000, that net income is understated by 100,000. Next is the relationship between ending inventory and net income. We have determined it earlier that the ending inventory and net income has a direct relationship. So ending inventory is overstated by 100,000. The net income is also overstated by 100,000. So again, net income is understated by 100,000 by reason of purchases being overstated. And at the same time, net income is also overstated by reason of ending inventory being overstated. So it actually corrects itself. So the net income is correct, but the individual balances are incorrect. So the balance sheet for that year is is incorrect. Well, the total assets, the total asset is overstated because the inventory end is overstated, and at the same time, liability is overstated as well because you have recorded purchases and credit accounts payable overstated by 100,000, so it is incorrect. Then 2021, your purchases now is understated by 100,000. Supposedly, you should record this upon when the inventory reaches its destination, which occurs in 2021. But because you already recorded it in 2020, your purchases for 2021 is understated by 100,000. And your ending inventory last year would be your beginning inventory this year. So if this is overstated, your beginning inventory is also overstated. So net income and purchases inverse. So understated by 100,000, net income is overstated by 100,000. Beginning inventory and net income also inverse. So if this is overstated by 100,000, net income is understated by 100,000. So again, it corrects itself. What about for the balance sheet? Well, balance sheet for this year is correctly stated. First, you have your accounts payable. Overstated 100,000 last year, understated 100,000 this year, automatically counterbalance itself. Same way, retained earnings is also correct. Because the net income in 2020 is correct, net income in 2021 is also correct, then retained earnings is actually correct. So correcting entries, you have two correcting entries because you have two mistakes. First, debit purchases, credit retained earnings. Okay, debit purchases because for 2021 your purchases is understated. So in order to correct this, you add purchases, debit. And credit retained earnings. Again, this is retained earnings beginning. your retained earnings beginning. So remember, purchases is overstated by 100,000. What's the effect on net income? That means the net income is understated by 100,000. That's why you credit retained earnings. Then for the inventory, your ending inventory last year is your beginning inventory this year. So if your ending inventory last year is overstated, it follows your beginning inventory this year is also overstated. So in order to correct that one, you credit, you reduce. And last year, your ending inventory is overstated. Net income in ending inventory is directly related. So your net income last year was overstated by reason of the overstatement of the ending inventory. So if net income is overstated, retained earnings is also overstated. So in order to correct, you debit retained earnings beginning. If you will notice, credit retained earnings, debit retained earnings, counterbalances itself. So if the error is discovered in 2022, there's no need for any correcting entry because everything is counterbalanced. Now, prepayment, deferrals, and accruals. So these are also examples for counterbalancing errors. Let's start with prepayment under expense method. So there are two methods in recording prepayment. So you have asset method, you also have expense method. On October 1, 2020, the entity recorded an advance payment for 1 year advertisement costing 12,000. So that's 1,000 per month. An expense account was initially debited. However, no appropriate adjusting entry was made. Supposedly, we're going to adjust at year end to determine how much is the unexpired amount. The unexpired amount would then be debited to prepaid asset and credit expense. But because we failed to do that, the advertising expense is now overstated. So if the expense is overstated, the relationship to net income is inverse. That would mean net income is understated. Your balance sheet is also incorrect because you were not able to recognize the unexpired portion. That means your prepaid expense is understated as well. Since your net income is understated, then net income is close to retained earnings. It follows retained earnings is understated. In 2021, the advertising expense is understated. Okay? Because all expenses have been recorded in 2020, okay? The portion for 2021 have not been properly allocated to 2021. So the advertising expense supposedly pertaining to 2021 has been lumped into 2020. So the expense for 2021 is understated. Since expense and net income is inverse, net income is overstated. So your balance sheet is correct because your prepaid expense is rightfully zero. So the whole 12,000 now have been expired. So your prepaid expense is actually zero. Everything is expired and retained earnings is counterbalanced. So if the error was discovered in 2021, you should debit expense, okay? Because the expense for 2021 is understated, and your retained earnings, or credit retained earnings because your expense last year, or rather your net income last year was understated. Again, this is retained earnings beginning. However, there's no need for any entry if the error was discovered in 2022 because again, the error is counterbalanced. Now, the thing here with prepayment, okay, it is counterbalanced because effectively, these prepayments will eventually be transferred to expense. This 12,000 will eventually transfer to expense. So if you correctly had the adjusting entry, the asset recognized, meaning the unexpired portion, will still be recognized or will still be transferred to expense next year. So eventually, all these payments will be transferred to expense. So if you erroneously fail to recognize an asset at the end of the year, it does not really matter because eventually that prepayment you fail to recognize will still be expensed next year. That's why it automatically counterbalances. So if you'll notice, in 2021, prepaid expense is rightfully zero because everything is now expired. Right? The whole 12,000 has been fully consumed. So there's no unexpired portion. No need to record any prepaid expense. And then your retained earnings is counterbalanced. Your income last year was understated. Your income this year is overstated. So automatically corrects itself. Note that such effect does not apply when asset method is used. So let us emphasize this one. Let's have an example where we use asset method. Okay, same problem. The entity recorded an advance payment for 1 year, 12,000. An asset account was initially debited. So you debit 12,000 prepaid expense credit cash. Supposedly at year end, you're going to determine the expired portion, debit expense, credit, prepaid expense. However, the entity failed to do that. So in 2020, the prepaid advertisement is overstated because you were not able to adjust. The income statement is incorrect because you're not able to recognize the expired portion, the expense is understated. As a result, your net income is overstated. Now, the balance sheet is also incorrect because the prepaid expense is overstated. The retained earnings is also overstated because the net income is overstated. Now, notice in 2021, assuming there are no entries, okay, no correcting entries, the prepaid advertisement is still overstated. Okay? Still overstated. Supposedly, by year 2021, since the advertisement is only good for 1 year, the prepaid advertisement balance should be zero. But because there's no correcting entry made, okay, the income statement is incorrect because the expense is understated. You fail to recognize the portion pertaining to 2021. So in the net income is overstated. The balance sheet is also incorrect because you still have prepaid expense. Supposedly, your prepaid expense would have a balance of zero in 2021 since the advertisement is only good for 1 year. So your retained earning is still overstated. Note the difference in terms of figures for balance sheet prepaid expense. In this case, the prepayment using asset method becomes a non-counterbalancing error. Okay? So if you will notice, it does not automatically correct itself. In the previous example, you debited an expense. If you fail to make an adjusting entry, well, it's not a problem because eventually all all prepayments would now go to expense. However, in this case, you debited an asset account, and over time, your prepayment does not remain as an asset. It will eventually expire. So without the correcting entry, your prepaid advertisement account will remain in your balance sheet, which is actually erroneous. So in this case, it does not actually counterbalance. So prepayment is only is belongs to counterbalancing error only if you use expense. The correcting entry will be discussed later when we discuss the non-counterbalancing errors. The same is true for deferrals using liability method. We will explain this later. Now, this is a